Well, good afternoon, ladies and gentlemen, and welcome to our Tuesday afternoon webinar here at Tradesmart University. I hope you guys are doing fantastic today. I was just looking at the market as we closed down a little over 200 points for the day on the Dow. Industrials there, and maybe it's somewhat prophetic that we actually are having a bearish market strategy webinar today on a day that the market's down over a couple hundred points. So kind of interesting, the timing on that. Anyway, I want to welcome you guys today to today's webinar. We're going to talk about 3 income strategies to help you thrive in a bear market. So how many of you get scared whenever when we talk about bear markets? Does anybody here just the idea of a bear market kind of start to scare you a little bit? Maybe not. I mean, some people get scared, some people don't, but I'm curious if anybody here starts to feel a little bit overwhelmed, a little bit fearful. That's one of the things we're going to talk about. We're going to start off today talking about the fear of bear markets. And then we're going to look at 3 strategies for bear markets, and we'll talk about how you can learn more. Bear markets, by nature, just the idea that the market would sell off creates a lot of fear for people. And that fear can be used in a good way, and it can also be used negatively. I just literally, maybe 20 minutes ago, received an email from somebody trying to sell me something based on their prognosis that the market is about to drop 50%. So, Jay, what would that do to you if the market were to drop 50%? Well, most people say that would be an incredibly scary proposition, and a lot of people think they couldn't survive that type of a situation. Whenever I think about bear markets don't scare me. In fact, I look at a bear market and what I see is opportunity. But for most people, bear markets are a scary place, and understandably so. In 2008, over $2 trillion of American savings were lost during the bear market of 2008. It actually started in 2007. It ended in the spring of 2009, but we refer to it as 2008 in general because that's kind of the heart of the crisis that happened there. And what's interesting is there's a lot of pressure. There's a lot of pressure during bear markets. There's pressure to sell, and then maybe you end up selling at the bottom instead of selling at the top. There's a lot of pressure that, you've got to get back to where you started from. And it becomes so great that a lot of people end up, delaying their retirement and delaying all sorts of stuff because their finances are so dependent on the way that they've positioned themselves in the market. Well, the big difference, I'm not sure if you guys saw it, there was a report, I think it was not USA Today, who's the other one? U.S. News and World Report did a report on how wealthy individuals fared during the 2008 crisis versus kind of the rest of America. And what they found that the majority of wealthy Americans, yes, they lost some money, but it averaged kind of like in the 12 to 15%. Whereas middle-class America, a lot of them lost 40 or 50% in the crash of 2008. You say, what's the difference? Well, part of it is the way they've allocated it, and part of it is simply the way they approach a bear market. So that's what we're going to talk about today. Some people look at the bear markets, they think it's a scary place. Some people see it as a big opportunity. For example, are you familiar with a guy by the name of John Paulson? John Paulson really was a fairly unknown fund manager before the 2008 crisis, but during 2008, during the subprime mortgage meltdown, John Paulson made over $4 billion personally. I'm not talking about for his fund. I'm talking about for him personally. He made over $4 billion trading the downside of the market. And since that time, he's more than doubled that. Forbes has his net worth today at right around $13 billion. And this is a guy that just a few years ago was relatively unknown. Most people didn't know who he was. Daily Mail reports that Warren Buffett made over $10 billion as a result of the bear market that happened in 2008. So here's the reality. The reality is there is opportunity if we can just simply find a way to see it. So here's my reality check for you as we get into these 3 strategies. The reality check is most people are afraid of a bear market. But for those who have the willingness to see it, bear markets provide huge opportunities. And that's really what I want to talk about today. Today, I really want to zero in on the possibilities of what you could do in a bear market. So I got 3 strategies for you. And the first one is a strategy for protecting yourself in a bear market. If I were to just do a quick survey here, and I don't have a poll queued up necessarily, but I thought I'd just ask you, and you can type in however you wish to. If I were to just do a quick survey and ask you, do most of you, whenever you think about a bear market, are you looking at going out and finding a way to protect your assets that you've got in the market? Or are most of you thinking, oh, this is an opportunity for me to go out, place some new trades, and make a lot of money? Where do you fall? I'm just curious. There's no right or wrong answer. I mean, if you've got a lot of assets, you need to protect them. And if you're looking at a money-making opportunity, then obviously you wish to do that as well. But I'm just curious where you're looking at. So just to read a few of these really fast here, Larry says both. Ejner, I think it's Ejner is the way I pronounce your name, says opportunity. New trade, says Paul. Thomas is looking for new trades. All right, so it looks like I have pretty active traders here. All right, so if you're a active trader, the strategy of using puts to hedge your stocks is not going to make you a lot of money. But if you have a portfolio, let's say you've got a diversified set of funds, or in general you've got a broad exposure to the market, then the way you want to protect yourself in a downturn is either one, you go to cash, or the alternative here is that you use puts to help hedge your position. So let's think about this picture here, the S&P 500, and we've rallied a little bit from here, but let's just take a look at it. You got a nice long-term trend, and let's say that you're getting afraid. The market starts to sell off a little bit. You start to get some fear, and your great fear is that the market is going to sell off substantially. What happens if? What if this thing sells off 20%? What if it sells off 50%? What happens if this thing starts to go tumbling down? Well, the put option is a tool that you can use in 2 ways. You can use it to make money, and you can also use it to protect money. There's 2 ways you can use the exact same instrument here. So if you are the stock owner, if you own the stock and you buy the put, what the put does is it gives you the right, but not the obligation to sell the stock for a certain price. That certain price is what we call the strike price. So this is going to help 2 different types of investors. It's going to help you if you want to hold your positions for a long time, but you're trying to protect yourself. And it's also going to help you if maybe your retirement or your investments, I should say, are tied up in some sort of a retirement account where you can't directly take control of your trade. So in both cases, you need to stay invested basically, but you're trying to protect yourself. That's where we're going to use this put option as a hedge. All right, so let's look at a hypothetical situation here. Let's say you got a $100,000 trading account, and I don't care if your actual account is $100,000 or $1 million or 500,000 or 10,000. It really doesn't matter. The principles work the same here. So let's just hypothetically say you have a $100,000 account and you don't manage it, or you don't want to close the positions. It's one of those 2 things. Either you don't manage it, so you don't have access to close the positions, or you don't want to close the positions. However, the outcome here is you believe that it's worth holding on to for the long term, but you're concerned about the market going down. So what do you do in this situation? Well, here's what we do. Rebecca says she's not hearing audio. Are you guys hearing audio? Check. Can you guys hear my audio coming through okay today? Anybody? All right, good. Nish says it's coming through. Frank says it's coming through. All right, I'll let my moderators work with Rebecca and see if we can't get her solved here. All right, so the scenario is you got a position, you want to hold it. So what we're going to do is we're going to use an index ETF, such as the spiders. I like to use the spiders. I like the diamonds. I like the QQQ. These are the 3 index ETFs that I tend to trade most frequently. So the spiders are a good one here. So we're going to use an index ETF like the spiders to manage this risk. And what we're going to do is we're going to buy put options on the spiders and use that as our hedge. So here's what it ends up looking like. The stock is currently trading, as of this chart, at around $185 a share. Now, we don't want to hedge at $185. We want to drop down out of the money a little bit so that we're not paying a lot of premium for this. Now, sometimes you want to buy in the money, but in a case like this where we're hoping the market will keep going up, we're just wanting to protect ourselves in the event that this thing really falls apart. So we're going to come out of the money a little bit, and we're going to buy a 180 put option. Now, how much time do we want to buy? Well, you don't want to buy forever. You want to typically buy about 3 to 4 months worth of time for this hedge. And I did a little research on this, and at this time, this hedge is going to cost us about $3.10 per share. Okay, so what we're going to do here is we're going to now have the right to sell the stock at 180. If the stock comes down, then great. We've got the right to sell it at 180. We got 3 to 4 months of time in this trade. Let's say we go out and buy 10 contracts. So how much does this trade cost us? It costs us $3,100. Now, we are protected. If the trade comes down, we've got ourselves backed up. Well, sure enough, a month later, the S&P drops down. In this case, it didn't drop a huge percentage, but it dropped down to 175, and it's down $10, which increased these options by $6.80. You say, how do we come up with $6.80? Well, let me help you understand this. Remember, we got the 180 spider options. Okay, so if the hedge is at $180, there's your strike price. If the stock has dropped down $6.80 below the strike here, so we were just below 175, that's going to be intrinsic value. So that's how we come up with $6.80. That is intrinsic value of the option. Well, guess what we can do? We can now go sell that option for $6.80, and we profit $3,700 on it. How did we come up with $3,700? Well, it's simple. We invested $3,100. We sold 1,000 shares, which is 10 contracts for $6,800. The difference there is $3,700, so that is our profit on this trade. Now, is that pure profit in your pocket? Well, it kind of is. It's $3,700 that will help offset your overall portfolio loss. If you're using this as a hedge, it will help offset your overall portfolio loss. So let's take a look here. And let's say you've got a broad market account worth $100,000, and let's say you just had a 5% sell-off. Well, that represents $5,000. So if you just have a 5% sell-off, well, you're in the whole $5,000 here. So be it, that's the outcome. If you use the puts as a hedge, here's what happens. You invested $3,100, but you more than doubled that in your profit. You got a $3,700 profit. That dropped your drawdown to only $1,300. So the difference here, by using the puts as a hedge, and you can fine-tune this, by the way. These are really raw numbers, but you can fine-tune this and make it a little bit better. But if by using the put options as a hedge, instead of suffering a 5% loss, we end up with a 1.3% loss. This is how wealthy individuals skirt through circumstances like the 2008 collapse, and maybe they only have a 10 or 12% drawdown instead of a 40 or 50% drawdown on their stock investment accounts. By the way, that is about the right ratio. I've got several friends that were fund managers during that time. One friend that I'm particularly close to, I know a lot of his numbers. And during the 2008 crash, I think at the worst point, he was only down about 6%. And the reason for that, while the rest of the market's down 45, 50%, his funds were only down about 6%. And the reason is because of the way he protected himself with hedges. All right, so it's a very valuable tool to protecting yourself if you've got broad market investments. Now, a lot of you today said that you're just looking to make money. You're not necessarily trying to protect yourself. So, if you are not protecting yourself, guess what? You could use the same tool. You're just not having anything to offset. You buy the puts without having a position to hedge, and guess what happens? That position that went from $3.10 to $6.80 now represents 119% profit in your trading account. And that's a profit of the trade, not the entire account. But certainly if you invest $3,100 and you pull out $3,700 in cash profit, it's 119% ROI. And that is another way that you can profit during a bear market, just simply using put options. In this case, we're taking the same instrument that we use for the hedge, but if you don't have something to hedge, then it just becomes an investment trade. And you can do that trade all day long and consistently make money during bear markets. So it's a great strategy. I use put options in bear markets all the time. It is really one of my favorite go-to strategies for that. All right, so that is one way that you can thrive during a bear market. Let's look at another strategy. And this strategy is a little bit more active. This strategy is going to be good for traders who have some individual stock positions, but maybe you're not wanting to get rid of them. And the idea here is that we're going to sell some covered calls against those shares. Yes, you could also go buy put options. You could put the two together and create an even more complex strategy that we call a collar. But let's keep it a little more simple here. What we're going to do is we're going to go out and lower our cost basis by selling covered calls. So this is the second way you can make some money during a bear market. So let's start talking about cost basis here. Cost basis is the overall price that you pay to get into a position. So naturally, everybody wants a lower cost basis. If you go out and you buy shares at $100 a share, then that's your cost basis, $100 a share. Let's say you buy 100 shares at $100, and let's say you buy another 100 shares at $90. Well, your cost basis for those 200 shares is $95 because it gets averaged out. Most of you, if you're familiar with dollar cost averaging, are pretty familiar with the idea of your cost basis. So here's how the covered call can help us here. What we're going to do is we're going to sell a call option against the shares that we already own. Now, if you don't already own the shares, you got to buy the shares. But if you own the shares, then this is a trade made in heaven for you. All you need to do is start selling options against the shares you already own. And in exchange for that, you get paid the premium for the call option. Then what happens is if time expires, guess what? You keep the stock. If time expires, you keep the stock and you keep the premium. Or if the stock goes up, you may end up selling the shares at the strike price, which if you set it up right, should still represent a profit for you. This is a relatively low risk trade, a trade that a lot of people feel very comfortable with. And in a bear market, it can really serve you quite well. Now, one little disclaimer here, it does need to be done in 100 share increments. So if you've got 98 shares of a stock, you need to buy 2 more shares. So you got 100 shares, and then you can turn around and start selling covered calls against it. But, you're not going to go out and be selling covered calls in odd increments here. You need to have 100 shares for every contract that you wish to sell. All right, let's take a look and see how this starts to play out on the chart here. So we've got American Express here. American Express is pushing up into $95 a share. So the first thing we're going to do, if you don't already own it, you've got to buy the stock. So let's say we purchase the stock at $94.91. Now, this is the most expensive way to do it. The better way to do this is to have gotten into the trade earlier. Let's say maybe you got in back here at $85 a share. That's ideal, but if you're not already in the trade, you're going to have to go buy some shares. So let's say you do it at $94.91. Now, for our example, what we're going to do is we need to go sell some options. So here's our rules that we're going to do. We're going to sell 4 weeks of time to expiration. So we're going to sell with 4 weeks to expiration, and we're going to sell 1 or 2 strike prices out of the money. And normally speaking, this is the ideal way to write a covered call. I'm going to show you another way in just a minute, but this is kind of the textbook ideal way. You buy the stock or you already own it, and then you sell 1 or 2 strike prices out of the money. So let's come over here. Notice we've got our American Express option chain pulled up. Let's zoom in. And with the trades trading at $94.91, we could sell an option at $96 or at $97 a share. Let's go with the lower one at $96. And if you look at the spread here, you notice you're at 92 by 104. So you can come somewhere in the middle here. You can put a limit order, and let's say that you sell these options for $1. So you put a limit order and say, I only want to sell these covered calls at $1 a share. All right, so sure enough, what do? You buy the stock, you spend $94.91. Now the second part of the trade, we're selling that $96 call. We're bringing in $1 per share. There's 100 shares per contract, so that's $100 that you get to keep. Now, if you did 10 contracts, you'd get $1,000. You can keep doing the math here. The more contracts you do, the more money you bring in. Now, watch what this did to our cost basis. So our cost basis started off at $94.91. But what we've just done is we just brought in $1 per share immediately. That's $100 in our pocket. That's $100 that we get to keep. Worst case scenario, we sell the stock at $96. Best case scenario, we keep the $100 and we keep the stock. And now our cost basis has been lowered down to $93.91. So we just brought an entire $1 per share off of our cost basis. Well, what happens if the stock keeps going sideways? What do we do next month? We turn around and we do the exact same thing again. And we do it again, and we do it again. And we try to do this as many times as we possibly can, because every month we can sit here and write the trade. Now, what happens if the stock goes up? If the stock goes up and it closes above $96 a share, then we're going to get called out of the trade. If the stock goes down or stays the same price, we keep the cash. Okay, so let's look at the two different ways that this could play out here. If the stock goes up, stock runs up, we sell at $96 a share. $96 a share is what we sell at. Our cost base was $93.91, so that's $209 in our pockets. Or another way of looking at it is $2.09 per share profit. That represents about a 2.2% ROI. In this case, it only took us about 4 weeks to get there. That is one way that this could go. Now, is 2% every 4 weeks a great deal? You know, most people don't get too excited about that, but if you did that every month, you know, that would stack up, and by the end of the year, you're making 20 to 25%. And most people would be pretty happy with 20 or 25% a year. So definitely that is one way that you can create some consistent income here. Now, what happens if the stock stays the same price or if it goes down a little bit? Well, let's talk about that. In the first month, your cost basis had dropped down to $93.91. In the second month, we do exactly what I talked about a minute ago. We just sell it again. Do the exact same trade again. And now we bring in another $100. Our cost basis has now dropped down to $92.91. And what happens the next month? Well, we can keep doing it again and again. So in a perfect world with the covered call, you stay in the trade and you keep lowering your cost basis. Worst case scenario, if the stock goes up, then you sell at the strike price. And as long as that strike price is above your entry price, you're still going to make a profit on that trade. That's why this is considered a fairly low risk trade. Let's take a look at an annual benefit of writing monthly covered calls. If all you did was just sat here and wrote these covered calls every month, let's say you could bring in about $1 per share about every 4 weeks. Well, in the first month, you bring in $1. Second month, you bring in $1 per share. It's $100 a month you're bringing in here. Over the course of the year, you end up with $1,200 you put in your pocket, and that starts to add up. Your cumulative percentage of income by the end of the year is over 12%, and you still own the stock, and your cost basis here is $82.91, meaning you could sell it at $82.91 and you still brought in the $1,200. That's your break even, $82.91. You've lowered that cost basis, but if the stock runs up, well, obviously you're going to recognize a whole lot of profit there. That's why this strategy is so valuable and why so many people really like it, especially during a sideways market like we've been stuck in recently. Now, what about supercharging it just a little bit? There's one tweak we could do in a bear market to supercharge the covered call just a little bit. And let me share that one with you if you'd like to see it real fast here. So here's how we could supercharge this just a little bit. If I can get my slides to go. There we go. What if you already own the stock and you know it's about to go down? So we're going to assume that your cost basis is not the current price. If your cost basis is the current price, this could backfire on you. But if your cost basis is lower than the current price already, then this is one way you could do this trade. And the way that we could do it is instead of selling out of the money options like you would normally do for a covered call, we could sell an in-the-money option, an in-the-money call option. So take a look here. Stock's trading currently at $67.50 or so. And what if we go sell a $60 call? That gives somebody the right to buy the stock at $60, and the stock's currently at $67.50 or so. Well, guess what's going to happen? You're going to bring in 100% of that premium, and instead of that premium looking like $1, that premium is going to look more like $7.50. Why? Because it's 100% intrinsic value. And this just becomes a short play. This is what it's just like shorting a stock, but you're shorting the option instead. And so this option is worth maybe $7.50. And as the stock comes down, all that intrinsic value is bleeding out of it. And you're starting to realize that profit. So watch what happens with this trade. Stock comes selling off. Well, now, once we're below $60 a share, that option goes down really, really fast, and eventually it's down to zero. Well, that's $7.50 you just put in your pocket. That lowered your cost basis further, assuming you were in the trade already, and I mean, it lowered your cost basis. No more and about it. Lowered your cost basis. That's money in your pocket that you can take there. Now, if you did get called out of it, then you'd have to sell at $60 a share. But as the stock is going down, then you can actually sell in the money, let it go ahead and expire, and you're going to keep that $7.50. Now, this is a strategy that a lot of people use as another way of kind of hedging their positions. I don't think it's a great hedging strategy. It's a good income strategy, not a great hedging strategy. And the reason is because there's a finite amount to how much you can hedge. Excuse me, kind of got a little cough going here. You know, the most you can make on this trade is the amount of premium you brought in, whereas if you bought a put option to hedge it, you can make a little bit more. And that's going to actually offset your losses a little bit better. But this is still a good strategy if you're in a bear market. And another way you could do this is you could pair it up with that put option as a hedge. Use the put as a hedge and use this as the income. So that's another way you could do it. But let me talk a little bit really fast before I leave this strategy. Let me talk about some of the dangers of in-the-money call options. If you don't mind, give me 1 second here. I just need to drink some water and clear my throat out. All right, let's give that a shot. So here's a couple of the dangers of the in-the-money call options when you sell these. It's not a complete hedge, as I just mentioned. It is not a complete hedge. Puts work better for the hedge component. What's good here with selling in-the-money calls is it brings in cash while the trade's going down. So it's another alternative way of shorting the trade during a bear market. There's another risk here, and that is the risk of getting called out while you're still in the money. You know, you're never going to get called out of a trade if you short an option. You're never going to get called out of that if you're out of the money. But if you're in the money, there's a good chance you might get called out of it. And so that is a legitimate risk. And if that strike price that you wrote is below your purchase price, well, you could get called out for a loss. So that's part of the risk here. There's one more risk that's kind of a hidden danger that in-the-money calls, and that is that there's tax implications here. Whenever you own a stock, if you go sell covered calls against it, those covered calls are going to get taxed as a short-term trade, not as a long-term trade. And it may, the rules are a little bit particular here, but it may make the entire trade get taxed at a short-term tax rate as opposed to a long-term capital gains rate. So that is one potential negative impact here. You can make the money on this short-term call, but it may end up costing you more in terms of taxes. So for some people, that becomes a negative trade, especially for people who are holding their trades for a long time. Now, for active traders, we're used to paying short-term tax rates on that. You know, it's not necessarily as big of a deal. But if you've got, let's say, a $100,000 portfolio of 5 or 10 different stocks, and you're wanting to hold those stocks over a long period of time, and you're wanting to hold them at least a year so you get taxed at a lower rate, this covered call could change those tax implications, and you need to talk with your accountant to answer that question specifically. But outside of those dangers, it is certainly a very good bear market strategy and one that you can use for your benefit there. All right, so there's two of the strategies. Let me share with you my third strategy, and this is another strategy I really like. If you're an active trader, you're wanting to make money and just find opportunities, you're not necessarily trying to protect your long-term positions, this next strategy is really a great strategy for a bear market. And the strategy title is what we call a bear call spread. It's a credit spread. It's an option spread. And it is simply using two different options to benefit during the trade. So let me show you how this is going to set up here. So let's say you got a bearish trade like this Apple trade. So you've got Apple today, continuing a sell-off. Notice that we're below the moving averages. We've got the bearish trade set up. I mean, everything about this is starting to scream bearish trend. And so you're thinking to yourself, yeah, I want to go sell some call options. Well, if you own Apple, great, it's a covered call. If you don't own Apple, well, it's not a covered call. It's what we call an uncovered or a naked call. And so there's some risk involved with that. And the risk is that the trade would go higher. It's always nice to bring in the money, the 63 cents a share, but the risk here is that the trade would run higher, and it could run substantially higher. And let's say that Apple runs up to 125 or 130 or 135. Well, you're sitting here in a short option that you sold, Somebody else has the right to buy it from you for 120, and you got to go buy it on the open market for 125 or 130 or 135. So there's kind of a unknown risk factor here. So how could we lower that risk? Well, what we'd like to do is we'd like to put a finite top to how high the stock could run. We'd like to limit that. And the way we're going to do that, a lot of people think a stop order is the answer, but let me suggest to you another option. So what if we came in here and we bought a 121 call option? Okay, now I know this, I had to draw this a little bit higher because the scaling wasn't quite right, but 121 is actually down here, just so you have a visual on that, but I couldn't squeeze it all on the screen, so I put it a little bit higher here. So here's what happens. Now what we've done is we've shorted the call option. Now we're obligated to sell the stock at 120 if somebody calls us out of it, but we go buy the 121 call, and now we have the right to buy at 121. So what did we just do? We just lowered our risk. Instead of having all that unlimited risk, now if the stock runs up, we get to 121, and that's a finite top. And it turns out that's not too far from where we started. So let's see how much this is going to cost us. If we pull up the current option chain on that, you can buy the 121 option for 45 cents. We could sell the 120 for 63 cents. There's a difference here. Do you see what's happening? There's a difference of 18 cents. That 18 cents is what we call the credit. So if we go buy the 121 for 45 cents, we short the 120 call for 63 cents, there's a credit of 18 cents. Now you say 18 cents, that's not much. Well, you start multiplying it out times multiple shares. You do 1,000 shares, it's $180. You do more contracts than that, and it starts to add up. Here's the key. The capital required to do this trade is 82 cents, and that means it becomes a 21.9% return on investment. And in this case, it's only for 2 weeks. That's pretty decent. So how many of you would like to make almost 22% in 2 weeks while the market is going down, selling the option? By the way, you've got a high probability of success. So if the stock goes down, great. You're going to realize 100% of your profit, which was 18 cents, the difference in the 63 and the 45. If the stock goes sideways, well, great. You're going to still realize 100% of your profit because you're not going to get called out of it there. So you're going to have 100% of that premium will end up in your pocket. If the stock comes up a little bit and it closes at or below 120, you'll end up with 100% of your premium. So you got, 3 directions here that it could go. Down, sideways, those are guaranteed profit. If it goes up a little bit, then you might have a profit. If it goes up and it gets stuck between 120 and 121, that's where you could lose some money. And you get beyond 121, and as the stock goes above 121, well, the 121 call option is hedging you, so you can't lose more than that. So you've limited your risk, you've predefined your reward, and you set the odds in your favor by at least 2 to 3. 2 out of the 3 directions it's going to go, but it's probably more like an 80 to 85% chance of this trade working out in your favor, and simply because of the laws of physics here, and the laws of the way that the market odds are going to work in your favor. Basic market odds are 30%. You buy a stock, there's a 30% chance it's going to go up, 30% chance it goes down, 30% chance it goes sideways. Well, with this strategy, immediately you've got 2 out of the 3. So there's 66% chance right there. And then if you add the reality that it could go up a little bit, you got somewhere in the 75, 80, 85% chance, just basic market odds, that this thing is going to work out. If you do this strategy in line with a good trend analysis, it's almost 100% of the time that it's going to work out in your favor, because you're selling these options in the direction of the trend, and you're using that in your favor. Now, some people ask, what if you sell one of these spreads in the money? Could you do that? And the answer is yes, you could sell this in the money. For example, you could do a 115, 116 spread. And what you'll end up with is a little bit of a credit, but you won't end up with the same kind of premium that you're getting if it's out of the money. So you have some more intrinsic value there. And, you just have to run those numbers, decide if that's worth it for you. Bigger chance, again, same risk here, the bigger chance of getting called out of the trade if you're selling an in-the-money option. Yes, you can do it, but there's a bigger chance of getting called out of it. All right. Is this an interesting strategy to some of you? Again, the name of the strategy is called the credit spread. It is one of several strategies that you could use in a bear market. Let me tell you how you can learn more. These are just 3 of the strategies. There's lots and lots of different strategies that you can utilize in a bear market. And we've got access to all those different strategies as part of our Tradesmart membership. So for those of you who are already members, I can show you, and I'll do that here in just a second, where you go access these videos and you can learn more about the strategies. If you're not a member, well, I just like to ask you, what would you like to learn? We've already got a training for that. So for example, let's say that you are sitting here today, you're saying, I need to learn how to choose a stock, or maybe I need some of those bear market strategies, or maybe you need to learn how to work with options. Some of the stuff I talked about today was pretty advanced option stuff. If that's you, well, let me show you where you can get access to all that here in just a second. Maybe working with indicators, more income strategies, technical analysis, day trading techniques, wherever you are in your trading, we've got some training for you. Risk management, creating trading plans, chart patterns, advanced options. We've got all of these subjects that we teach as part of our training here at Tradesmart, and it's all included with every membership. So those of you who are already members, you want to learn more about options and option strategies, Options Made Simple 101 and 201, this is where you want to go. For those of you who are trying to figure out a little bit more about how to pick a direction for a trade, Foundations of Stocks and Options is the ideal place for you to start. Or maybe if you're having a hard time targeting where the trade needs to go, maybe Fibs and 4 is a good place for you to go. So we've got the training for you. The question is, where do you need to go? We've actually got over 200 hours of videos available for you, and it's all available right here in your membership area. So the question that I've got for you is, what is it that you want to learn? And I'll be happy to help you. And of course, our student success coaches and moderators will be happy to help guide you towards the classes that will help you learn what it is that you want to learn. Now, you may be wondering, how much is all this going to cost me? Well, I've got great news for you. If you go to some of our competitors, you're going to spend $12,000, $4,000, $6,000, maybe $16,000. Well, at Tradesmart, we've included it all for one monthly price, and that monthly subscription is just $89 a month. And if you decide after a month or two that you've learned everything you need, well, great, no problem, you can move on. If you decide that, hey, I need to keep this, well, great, you can continue at just that monthly price. And you're not going to get in here and find that there's a whole bunch of additional classes that you got to buy. This is it. This is what we've got available. It's everything is included. Literally everything is included. So you have access to all of our trading courses. Over 20 courses are available to you. All the on-demand recordings are available. Plus, we do these live webinars 4 times a week. The one we're doing right now is kind of a preview webinar, but during the main webinars during the week, we've got our trading labs, we've got our power trader classes. And what these classes are is they're your chance to learn from us as teachers as we show you different things that are happening in the market. So those are live webinars that happen 4 times a week, all included as a platinum member, unlimited access to all of that. Plus, you get access to our monthly Mastery Series webinar. Every month, we do a new webinar on some individual subject. It changes every month, but we call that our Mastery class, and it's just going deeper into a subject. All of our new courses are included. We include anything that is that we create, that we're releasing. That all gets included as a platinum member as well. And of course, our weekly Tradesmart sentiment indicators and weekly trade ideas, and all of our membership area. Those are kind of included with everything. So this is our platinum membership, and if you're wanting to get access to that, if you've not already done so, then this is a great opportunity to do that and just see all the great courses that you have access to. Again, this is a one-time monthly price. There's no additional upsells, and it's all included. Now, here's what I'd like to do for this webinar. I've got about 60 or 80 of you in here today. And what I'd like to make available to you is a trial. And I realize that, just jumping into a new subscription may be a little bit daunting for you at first. And so what I'd like to do is I'd like to encourage you, come try it for 14 days. And the price on that is just $4.95. I mean, it's a cup of coffee. And I think what you're going to find is the level of training that we've got available to you is unbelievable. The content that we've got available is top notch. It's top of the industry. And you're going to really find that, for $89 a month, you're not going to get a better value. So I'd love to ask you to come try it out for 14 days. Let me share with you a couple of our student stories. Mary and Tracy, they wrote in and they said that risky business has really put me on the leading edge. This is one of our risk management programs. It said, when Alfonso brought forth the R's trading and I started using it, changed my trading completely because now I know exactly how much I'm going to lose, whichever way it goes. It's not going to worry me. And this is one of the programs that's included with all of our training, risky business, about risk management. How different is your trading when you know exactly what you're getting into before you get into it? It's all included here with your basic membership. So here's what I'd like to do. We've got a little bit of time left, and I know some of you need to leave. I promised I'd have you out of here in less than an hour. But if you need to leave, I certainly understand. What I'd like to do here is I'd like to actually head over to Tradesmart U, and I'd like to kind of give you a quick orientation into what it's going to look like when you get signed up. Because I got some of you here today that have already signed up as members, and you're not quite sure what to do. And I got others of you that are sitting here saying, I think I might like to become a member, but I'm not sure what I'm getting into. So let me help both of you by taking you over to our membership area, which I'm trying to get my web browser to come up here. It's not cooperating with me. All right, here we go. So whenever you come to tradesmartu.com, notice in the upper right corner of the website here, there's a login area. You see that login? You just need to click on that. And if you've already set your membership area up, then great, you just log in. Shoot, I was already logged in. So let me log out so I can show you what it looks like when we sign in. Start all over again. Tradesmartu.com. All right, so when you click on login, it will bring you to this login area. Now, if you've already got a membership, then great. Just put your credentials in here and put your password in. If you have not got a membership yet, if you've not set your membership area up, you need to click on the register button. And what the register button does is it walks you through the registration process. All right, but assuming you've already got your information, then you're just going to click on sign in. And when you sign in, it dumps you out here on our membership area. And this is where all the great goodies are included. So some people get confused. They say, I don't know how to access the classes. Let me show you how you access the classes. Right here in the middle, these are all of the courses that are available to you. And so it says My Courses. Well, those are all your courses. If you want to start watching Foundations of Stocks and Options, you just click on Foundations of Stocks and Options, and it brings up the program, and then here's all of the individual classes that are included as part of the Foundations of Stocks and Options. If you want to watch Options Made Simple, let's say you want to get better at trading options, so you start watching Options Made Simple. You just click on Options Made Simple, and then again, it's going to pull up all the classes, and you just click on whichever one it is you wish to watch, and it will pop up the video, and then you can start watching that class. All right, so that's how you get access to all of the individual classes. Now, if you want access to the live trading labs and our live webinars, well, notice across the top, you see where it says this week's live classes? Okay, so there's our schedule. You can see that Mondays, that was me yesterday. Tuesday, Josh is doing a webinar. Thursday, Alfonso's doing one. Sunday is our power trader. And if you want to access that, there's a couple ways you can do it. One, you can just click right here, right there in the middle of it, and it pulls up the Trading Labs program here. And you see where it says register for live class? Well, just click that, and it will register you. If the live class is launched, if it's live, it'll actually log you right in. Otherwise, it will just register for you to register you for the class. Now, the other way you can get to it is down here in your My Courses section. You see where it says Trading Labs. So if you click on Trading Labs there, it will take you to the same place. And if you click on that, watch what happens. Boom, there you are. And again, here you can register for the live class or log into the live class. And again, it will be a GoToWebinar meeting just like what we're doing today. So that's how you get access to those areas. Now, if you want some trade ideas, notice this whole thing, it says trade ideas right up here. Well, you just click on it, and guess what it's going to do? It's going to download a PDF for you of this week's trade ideas. And you see there's a little write-up about the market. And then if you scroll down, you're going to see that we have done some scans, and we've come up with some trade possibilities. Now, don't think that these are just raw scans. They are not. They start off as scans, and then I go through them, and I put some intelligence into them. and we pick out kind of the ones that have the highest probabilities of playing out. So you got, first you'll see our Bollinger Band squeeze trade ideas. These are all trades that are in Bollinger Band squeezes. The ticker symbol, the company, and the last closing price. And then below that, you'll see new bullish trends. These are stocks that are in bullish trends. And if you come down below that, you'll see bearish trends. These are stocks that are possibly setting up for some good bearish trends. For example, last week on this list was Apple Computer. And so, that's one example of a recent stock that was on the list a week ago. And, here we are a week later, and it's been in the middle of a bearish trend. So, those are some of the things that are available to you here in the membership area. All right, I think I've given you a pretty good overview there of the membership area. Let me open it up and answer some questions for anything that you guys might have questions for today. And then we can go from there. So let me start with Rebecca. I think she's the only question I got flagged here. Rebecca says, where do I look for a recap or more examples on the bear call spreads, because I didn't quite follow it and I need to review it again. All right, great. Rebecca, let me show you. Rebecca, there's two places where you can go for this. The complete credit spreads class is the ideal spot, and it's right here. Okay, so there's the credit spreads class, and that will go. That's 4-class series that goes through everything on credit spreads. If you want a more basic introduction, go to Options Made Simple 2, which is the blue Options Made Simple. And depends on where you're getting confused. If you're getting confused on the shorting of options, you should start with class 3. If you're just getting confused on combining strategies, then you can come on down. Come on, scroll down. Oh, I got my pen on. That's the problem. There we go. You can come on down to class number 7, where we call the playbook. And this will walk through those individual strategies as well. Part 4 and Part 5 get into those credit spreads. So that's kind of the front end of the learning curve, Rebecca, in terms of branching out and understanding those strategies. And then again, if you want the more advanced program on credit spreads, we've got a program called Advanced Trading Strategies Credit Spreads. All right, does that help you out there, Rebecca? Did you see all that? All right, are there any other questions that I can answer for you today? Let me remind you, if you do want to sign up for membership and you wish to do it with this special, the $4.95 trial, you need to go to tradesmartu.com/special. If you don't go to tradesmartu.com/special, then you're not going to have access to the special pricing. So you're going to have to go to that particular address. All right. Any other questions I can answer for you? If not, then we will call it a webinar for the day. Any other questions here? I don't see any questions. So I guess we will wrap it up. I see a couple questions about, will it be recorded? This webinar is recorded, and I'll post it up to YouTube here in a couple hours after we get everything rendered. So you guys can rewatch it if you wish to do so. All right, you guys have been great. Thanks for joining me today, and I hope that some of these bear market strategies have given you a good idea of what you can do in some bearish markets. So until we get a chance to meet again, happy trading to all of you. Have a great afternoon.